A flash mob of online traders briefly sent an unloved stock really high. Hi there, welcome to Plain English lesson number 338. I'm Jeff. JR is the producer, and this full lesson is online at plainenglish.com/338. Coming up today, GameStop is a chain of video game rental stores. They're in shopping malls all across America. For most of 2020, investors thought it was a dying business, and then its shares increased over 1,000%. We'll talk about what happened today. The expression is run for cover, and we have a quote of the week. Let's get started. A flash mob of online traders sent the stock of a little-loved video game chain soaring and some powerful hedge funds running for cover. GameStop is a publicly traded retailer that sells video games in shopping malls. For the better part of last year, the investing community thought that GameStop was a dying business. Video games were moving online, and the chain of in-person stores didn't seem to have an answer to shifting consumer trends. Meanwhile, foot traffic in shopping malls is down. The stock was trading for about $18 per share at the beginning of the year. It had been trading as low as $2.57 per share earlier in 2020. On January 11th, news came out that a single investor had accumulated almost 14% of the company's stock, which is a lot for a public company. As a result, that investor would be able to appoint 3 members to the company's board of directors. The activist investor, RC Ventures, has a reputation for success in online business. This was legitimate good news for GameStop. There would be changes at the top driven by investors with success in online business. Perhaps GameStop would be able to turn its business around. Its stock rose 10% in a day, reflecting greater optimism for the future. So far, so normal. These are the typical ups and downs in fortune that smaller public stocks experience. But then something very strange began to happen. On January 25th, a Monday, the stock finished the trading day in New York at $76 per share, now 4 times higher than it began the year. That's a big gain. Yes, there were good signs for its future, but was the company now really worth 4 times more without having executed a change in its business model? On Tuesday, the price almost doubled again. It closed the day at $148 per share. On Wednesday, it doubled yet again to $348 per share, now 20 times higher than it began the year. At one point during the day on Wednesday, it reached $469 per share. By Thursday, it plummeted down to $193 per share. On Friday, it was up to $325 again. There was so much trading that some brokerage firms had to stop customers from buying new shares because their brokers were unable to handle all the volume. All of a sudden, this unloved company that serves teenagers in dying shopping malls was front page news around the world. The dramatic rise in GameStop's share price was out of all proportion to the company's success or prospects. There was something crazy going on with GameStop, and it came from, of all places, a message board on Reddit. Let's take a step back in time. Remember when I said that GameStop was unloved? That many investors thought it was a dying business? Some larger investors have a way to bet against a stock, and it's called short selling. Selling a stock short is complicated, so I won't explain the whole thing here. But in a short sale, if a stock's value goes down, those big investors profit. If the stock's value goes up, those investors lose. Just the opposite of what most people do when they buy stocks. There is one more thing to know about a short sale, though. There's no limit to your potential losses. The value of a normal investment can fall to zero and you lose everything, but you never lose more than you invest. In a short sale, however, you can lose much, much more than you invest. That's why it's risky. Now let's go to Reddit. An online forum called Wall Street Bets advocates, even celebrates, taking risks on stocks, sometimes crazy risks. A movement started on Reddit to buy up the shares of GameStop. Small individual investors started piling into GameStop, driving the price up. Some did it because they thought GameStop's future was bright. Remember, there was legitimate good news. Others bought GameStop to follow the crowd, for the excitement. Still others did it for a different reason. They knew that some large investors had sold GameStop short. The higher GameStop's stock went, the worse it would be for those large investors. A lot of people in the forums took some joy in buying a stock and driving its price artificially high so as to inflict the most pain possible on those investors who were betting against GameStop. And it worked. The large hedge funds that had bet against GameStop lost billions of dollars in a week. Two had to be rescued by other funds. Essentially, they were at risk of going out of business. Some people on Reddit took particular pleasure in seeing that news. The GameStop story is the story of a classic financial bubble. The same story has repeated in different forms for many kinds of investments for hundreds of years. Not just stocks, but land, houses, gold, oil, currencies, Bitcoin, even tulips as far back as the mid-1600s. Bubbles start with some legitimate good news. A herd mentality takes hold. People see others making money, and they experience the fear of missing out, so they pile on. People get an adrenaline rush, and some people get really rich in the process. A bubble can last for a week, a month, or several years, but eventually people realize the price of the investment is out of proportion to its true value, and they sell one after another, and the price falls as dramatically as it rose. The air started to leak out of the GameStop bubble the next week as the shares fell to about $63, down from their high of $347 at the height of the mania. I said that in a classic financial bubble, there's usually a source of new money. It's actually related to a recent lesson we did here at Plain English. In lesson 199, we talked about how the price to buy and sell stocks has fallen to zero. And since that time, new apps have made trading stocks as easy as playing a game, and a trade is free. A lot of individual investors are now buying individual stocks in much greater numbers, thanks to no-cost trades and modern apps like Robinhood. I'm writing and recording this on February 7th, so who knows what has happened since then. Check on Google Finance to see what happened to GameStop since then, if the mania came back, or if the price settled back down to where it was earlier in the year. And if anyone is a new GameStop millionaire, be sure to take a picture with your new yacht and post it to our Facebook group at plainenglish.com/Facebook. Today's expression is to run for cover. If you find yourself in a dangerous situation and you need protection quickly, you have to run for cover. There are lots of ways to use this, so let me share a few common ones, and then I'll share how you heard it in today's lesson. Here's the easiest way. You're out and about, enjoying a nice day, maybe taking a stroll down a city street or even going for a walk in the park. Then storm clouds start to obscure the sun. It starts getting dark. It looks like rain. You're getting a little concerned, but you're not panicking yet. Then it starts to pour down rain and you don't have an umbrella. You look at your friends or family and you yell, "Run for cover." You're going to run as fast as you can for protection from the rain. Run for cover. Go find a bridge to stand under. Find a restaurant that will let you in. A doorway to an apartment building. It doesn't matter. Just run as fast as you can to a place that will give you protection. run for cover. Here's a funny story. I have only felt an earthquake once in my life. It was mild, but noticeable. I was on probably the fourth or fifth story of an office building in North Carolina, the east coast of the US, where earthquakes are rare. We felt the whole building shake. It didn't feel dangerous, but it was a sensation I had never felt before. I knew immediately that it must be an earthquake. There was nothing else it could be. I looked around at the people in the room, and we just kind of laughed and checked the news. After a few minutes, the news was confirmed. One person in the room, though, had a different reaction. He ran for cover. As soon as he realized what it was, he jumped up from the big table we were all working at. He jumped up and ran to the nearest stairway and stayed in the stairway. He ran for cover. I kind of laugh now, but that was probably the safest thing to do. The rest of us were just enjoying the moment, laughing next to these huge glass windows. Maybe we should all have run for cover. In Melbourne, Australia, pedestrians ran for cover after a speeding car jumped onto the sidewalk. They were in danger of being hit by the car, so they ran for protection. They ran to get out of the way. They ran for cover. So those examples are all really running from physical danger. We use it metaphorically when you seek help in a dangerous situation. And in today's main lesson, I said that GameStop's stock rose dramatically after many individual investors started rapidly buying up the shares. But some big investors ran for cover. They were in real danger. What happened? Remember, they were the short sellers. They bet against the stock when it was like $18. They thought it would be going lower. Instead, it went high. The losses of two big hedge funds piled up and up and up. They stood to lose more money than their entire funds had. Those hedge funds ran for cover. Together, they lost $5 billion in a week. Ouch. They had to buy shares as the price was rising. A few hedge funds needed to be rescued by even bigger financial firms. When I said those investors were running for cover, they were looking for protection. They suffered losses, but they needed to stop the losses as quickly as possible. It's like you being stuck in the rain. You're wet, but you're looking for protection to keep from getting even more uncomfortable than you already are. You can use run for cover when you are trying to avoid criticism or avoid something bad happening. I remember a few years back, big companies, big established global brands found their ads were being shown next to offensive videos on YouTube. Starbucks, Pepsi, General Motors, AT&T, Johnson & Johnson, They all ran for cover when they realized that their ads on YouTube might be shown right alongside a neo-Nazi video or a video supporting terrorism in the Middle East. Those brands ran for cover. They immediately suspended their YouTube advertising and tried to distance themselves from any offensive material on YouTube. YouTube has since changed its system for advertising, but this sort of thing will always happen when big companies associate with sports stars, actors, celebrities, music stars, or user-generated content. The advertiser will often run for cover if the celebrity they're associated with is involved in some kind of scandal. All right, so I know what some of you are thinking. If GameStop well and truly was way, way above its value, then wasn't that the time to sell it short? Shouldn't new hedge funds step in and short GameStop? After all, it does have to fall way down eventually, right? The market was definitely irrational with this stock. You could surely have made money betting against it when it was so high. Well, that leads us to today's quote. The origins are a little fuzzy. It's often attributed to the economist John Maynard Keynes, so we'll go with that. He was cautioning people from betting against irrational markets. Yes, markets can be irrational, and yes, most of the time they will return to reflect true long-term value. However, that doesn't mean an individual can have success betting against a financial bubble, because the bubbles can last quite a long time. Here's his quote. Markets can remain irrational for longer than you can remain solvent. That means you might be right that markets are irrational, but if you bet against them, you might go bankrupt before markets return to their senses. Markets can remain irrational for longer than you can remain solvent, says, we think, John Maynard Keynes. And that is all for today. Thanks for joining us for today's lesson. Remember, we're here every Monday and Thursday with new plain English lessons. You can get even more online at plainenglish.com. A free membership includes the full word-for-word transcript and our archives of hundreds of expressions and phrasal verbs. Coming up on Thursday, we'll talk about an unintended consequence of wearing masks, how they hinder nonverbal communication. Think about that before Thursday, and we'll explore that in depth. Speaking of in depth, if you'd like to go more in depth with plain English, you have the opportunity to do so as a member of Plain English Plus. What do I mean by in depth? We walk you through exactly how to use the trickiest parts of language with video lessons and opportunities to practice. Today's video lesson is all about how to use the phrase as a result to show cause and effect. And with each lesson, we do another 10 or 20 minute video showing you exactly how to sound more professional and be more versatile in English. Enough of those short, choppy, simplistic sentences. Watch these videos, practice in our forums, and you'll see results before too long. So, if that sounds like what you need, then come visit us at plainenglish.com/plus, PLUS.